My name is Pim Lievense, Senior Responsible Investing Specialist at NN Investment Partners. Responsible investing has been on the rise over the past decade for institutional as well as retail investors globally. Regional differences in terms of width and breadth of implementation exist. European, and more specifically Northern European institutional investors are generally recognized to be thought as well as practice leaders in the field of responsible investing. European policy and lawmakers have also directed their attention to the field of RI. For example, the 2013 Dutch legislation Wet Marktmisbruik prohibits institutional investments in manufacturers of cluster bombs. Therefore, it shouldn't come as a surprise that the European Commission in 2018 has launched the EU Action Plan on Sustainable Finance. In this part, we will address the goals and objectives of the Action Plan, the various elements which the Action Plan comprises, and the supposed impacts, as well as timelines the Action Plan will have on institutional investors. The EU Action Plan was adopted by the European Commission in March 2018, and the recommendations of the high-level expert group on sustainable finance form the basis of the plan. The high-level expert group, consisting of 20 expert members, has provided advice to the European Commission on 3 key objectives. Firstly, advice on how to direct both public and private capital flows towards sustainable investments. Secondly, advice on the steps that financial institutions and supervisors should take to protect the stability of the financial system from risk related to the environment. And thirdly, advice on how to execute the policies on a pan-European scale. The European Commission has identified 5 key challenges in relation to sustainable finance and has defined actions that should overcome the challenges. The key challenges are: firstly, there is no common definition of sustainable finance. Secondly, there is a risk of greenwashing of investment products. Thirdly, banks and insurers often give insufficient consideration to climate and environmental risks. Fourth, investors often disregard sustainability factors or underestimate their impact. And lastly, there's too little information on corporate sustainability-related activities. So based on the advice, multiple actions have been identified, which will either result in new legislation or in the development of new standards and labels. So let's focus on the actions that have the highest direct impact on an institutional investor, namely new regulation. In May 2018, the Commission adopted a package of measures implementing several key actions announced in its Action Plan on Sustainable Finance. So the package includes, firstly, a proposal for a regulation on the establishment of a framework to facilitate sustainable investment. And this regulation establishes the conditions and the framework to gradually create a unified classification system, or a taxonomy, on what can be considered an environmentally sustainable economic activity. So this is a first and essential step in the efforts to channel investments to sustainable activities. And in June 2019, the Technical Expert Group has published its taxonomy report. The key takeaways from the work that the Technical Expert Group has undertaken is that 67 economic activities have been identified that can make a substantial contribution to one of the following environmental objectives: either climate change mitigation, climate change adaptation, sustainable use and protection of water and marine resources, a transition to circular economy, waste prevention and recycling, pollution prevention and control, and lastly, protection of healthy ecosystems. A methodology has been developed for evaluating substantial contributions to either of these goals. It is important to add that minimum requirements have been built into the methodology to prevent significant harm to other objectives. Now, what classifies as an economic activity that contributes substantially to climate change mitigation? 3 sets of activities have been identified. So first of all, activities that are compatible with a 2050 net zero carbon economy. Secondly, activities that contribute to a transition to a net zero economy in 2050, but are not currently operating at that level. An example in this type of activity is the production of a car with emissions below 50 grams of CO2 per kilometer traveled. And thirdly, activities that contribute to the first two activities. As an example, the manufacturing of wind turbines. Then, back to the EU Plan on Sustainable Finance. Its second objective is a proposal for a regulation on disclosures relating to sustainable investments and sustainability risks. So this regulation will introduce disclosure obligations on how institutional investors and asset managers integrate ESG factors into their risk management processes. Delegated acts will further specify requirements on integrating ESG factors into investment decisions, as this is part of institutional investors and asset managers' duties towards investors and beneficiaries. So the current proposal stipulates the following ESG requirements for asset managers. Explicitly requiring the integration of ESG risks in the investment decision or advisory processes as part of duties towards investors and/or beneficiaries. Also introducing mandatory disclosures on how ESG risks are integrated in the investment decision and advisory process. And lastly, in addition, where financial market participants and financial advisors advertise and sell financial products or services that claim that such products or services pursue sustainable investment objectives, then obliging them to disclose information on the contribution of the investment decision to the sustainable investment. The second key action of the EU plan is a proposal for a regulation amending the benchmark regulation. The proposed amendment will create a new category of benchmarks comprising low carbon and positive carbon impact benchmarks, which will provide investors with better information on the carbon footprint of their investments. In the third quarter of 2019, the Technical Expert Group published its final report on climate benchmarks and benchmarks ESG disclosures. The report details the construction criteria for two types of climate benchmarks, namely the so-called EU Climate Transition Benchmark and the EU Paris-Aligned Benchmark. It also details the disclosure requirements that shall be applicable to all investment benchmarks. And the EU Climate Transition Benchmark has an explicit CO2 reduction target of 30% compared to the investable universe. This must be based on Scope 1 plus Scope 2 emissions. In other words, direct as well as outsourced emissions initially, but will bring in Scope 3 emissions, which are the emissions of the produced end product during its lifetime of the product, into scope with a maximum period of 4 years. Next to this, the benchmark should exclude producers of controversial weapons, as well as norm violators. The EU Paris-Aligned benchmark has a 50% CO2 reduction target and will exclude coal, oil and natural gas producers, as well as energy utilities that use these fossil fuels, all subject to a maximum percentage of revenue derived from those fossil fuels. Now, this means that this benchmark will have a risk-return profile that may deviate substantially from traditional benchmarks. Finally, a last key feature of the action plan is to create EU eco-labels for financial products. The eco-label would cover a variety of green financial products, including green bonds. Moreover, the eco-label will provide information to retail investors on whether a financial product respects a green standard.
Hello everyone, my name is Jeroen Bos, board member of CFA Society VBA Netherlands and head of specialized equity and responsible investing at NN Investment Partners. In this part, we will address the role of ESG scores in the investment process. The role of environmental, social and governance aspects in the investment process has clearly become more prominent in recent years, and rightly so. ESG aspects can have a material impact on the long-term growth and profitability of companies, the sustainability and longevity of business models, and therefore also valuation. As a result, ESG can influence the investment performance of securities like stocks, bonds, real estate and other assets in financial markets. Therefore, it is important to integrate these into one investment process. You can even argue that if you haven't looked at ESG yet, you haven't really finalized your investment analysis and due diligence, and you are likely not ready yet to make the best informed investment decision. One of the ways one can look at ESG aspects of companies is to look at ESG scores from research providers. There are a range of providers in the market offering ESG research, data and scores, including firms like Sustainalytics, MSCI, Refinitiv, RepRisk, True Value Labs, to name a few. ESG scores can tell you something about how well a company is doing on environmental, social and governance aspects, both from an absolute level as well as relative to comparable companies. This can help investors judge if the companies in their investment portfolio score well on ESG or maybe score poorly and therefore have ESG risks that may warrant further investigation. ESG scores are, for example, driven by features such as the strength of a company's governance, how well the company is treating their workers, or, for example, how well the company is treating the environment they are active in. You can also calculate the ESG score of an investment portfolio. You can do this by calculating the weighted average ESG scores of all the individual investments in a portfolio. The ESG score of a portfolio can in turn be compared to other portfolios to see which portfolio have higher or lower risks from an ESG perspective. So a portfolio scoring better on ESG could have lower environmental risks and exposures, for example when looking at CO2 emissions. The same logic holds for social and governance aspects, where portfolios with better ESG scores could have less risks in the area of governance or on certain social aspects like supply chain risks. It is, however, important to note that ESG scores of companies and investment portfolios have some angles to be aware of when using these scores to assess the ESG quality and sustainability profile. Firstly, at some of the ESG rating providers, there's still often a size bias in the data, meaning that larger companies have, on average, better ESG scores compared to smaller companies. This doesn't always necessarily mean that larger companies or portfolios with larger stocks in it are more sustainable in terms of business model or treat the environment or society better. This is actually often the result of larger companies having more resources to develop and maintain a range of policies in the area of ESG. Secondly, most ESG scoring methodologies often include some kind of sector neutrality, meaning that the best companies in the sector will have above average ESG scores. A clear conflict with sustainability could arise, as companies active in, for example, weapons, tobacco or traditional energy can still get high above market average ESG scores driven by its policies and this sector neutrality feature. Thirdly, do note that the correlation between the ESG scores of different rating agencies are low, sometimes as low as 0.3. The low correlation of ESG scores of the different rating providers was again confirmed by recent research done by MIT University in the US. This means that ESG ratings on the same companies can be very different at different ESG rating providers. This actually shows that methodologies of the different providers differ and sometimes change through time as well. Therefore, one could argue that there's no universal truth when it comes to ESG. As a result, ESG can be a good starting point when judging the quality and sustainability of companies and portfolios, but to get a better and more complete insight, it is recommended to look beyond the simple ESG scores and to the reasoning behind these scores. So to summarize, ESG scores can help give better and more complete insights into the risks and opportunities of securities and portfolios, and lead to a more complete approach to investing. Portfolios that score better on ESG usually have a lower risk profile compared to investment portfolios that score worse on ESG. At the same time, it is important to realize that although ESG scores can provide some good insights into the risks and opportunities, they can still have some biases. It is therefore recommended to always look beyond the standard ESG scores and ratings and use these as simply the starting point to improve the overall decision-making process. When talking about responsible investing, it is important to define what we actually mean. In the market, there is still no clear, straightforward definition, and for different investors, investing responsibly has a different meaning. For some investors, this would mean excluding or divesting specific assets. For others, it means doing investments which contribute to the environment or society. For others, it is to take non-financial aspects in the area of environmental, social and governance into account when making investment decisions. When looking at the latter, adding ESG insights to the investment process should improve the quality of the process and lead to better investment decisions, and is simply a more complete approach to investing. It is clear that investing in a responsible way is gaining in popularity and becoming the new normal, whichever definition you use. However, with the rising popularity of ESG and responsible investing, there is an increasing risk of greenwashing. Simply put, with greenwashing we mean a situation in which one actually pretends to do much more with ESG aspects in their operations or investment process than actually is the case in practice. Greenwashing can be done by both companies and investors. Companies can, for example, do great marketing about how sustainable they are by using examples that maybe only represent a very small portion of their activities. By doing this, they create the illusion of being a very sustainable company, but could actually be doing very poorly on ESG in the rest of their business. On the investor side, we could see the same in terms of greenwashing. Doing well on ESG is great marketing these days, hence almost all asset managers and asset owners claim to do a lot on ESG integration. In practice, however, an asset manager could do very little when it comes to ESG and responsible investing. So it is important to investigate what asset managers or asset owners are actually doing in this area in practice, and don't take the marketing stories for granted. As a result of greenwashing, we now also see European and local regulators developing standards for sustainability and ESG integration, and this should help counter this phenomenon.
The costs associated with climate change are huge under all likely climate change scenarios. So for investors, this means that specific climate change-related investment risks should be identified. The risks associated with climate change are generally referred to as either physical risks, technological risks, or regulatory risks. And there's always a flip side to it, meaning that risks related to these topics can be opportunities as well, of course. Physical risks associated with climate change relate to business operations that are impacted by extreme weather events resulting from global warming, such as hurricanes, water scarcity, or flooding. Business operations can be negatively impacted by these type of risks and can cause direct physical damage to buildings or indirect damage relating to downtime of operations as a result of extreme weather events. The technological risks associated with climate change relate to risks and opportunities as a result of the transition to a green economy. In the light of the energy transition, existing techniques can become obsolete or may incur significant impairments. An example of transition risks is visible in the automobiles industry, where conventional combustion engines are being replaced by electric engines. And the additional investments that conventional car manufacturers will have to make are huge, and competitors that have exclusively focused on electrification have a competitive advantage. Regulatory risks associated with climate change stem from changing rules and regulations around the cause of climate change, being carbon emissions. Placing hard or soft caps on emissions and rising prices for emission rights pose risks for high-emitting businesses. Some national or local governments are banning diesel-fueled cars, and others are closing down thermal coal-powered engine plants. So these are examples of regulatory risks that relate to climate change. Ultimately, existing techniques, resources and assets can become obsolete as a result of technological or regulatory developments. When this occurs, assets may become stranded, in other words, worthless. Institutional investors apply a myriad of policy instruments to mitigating these risks. Engaging investee companies on climate change-related risks, as well as bringing down the CO2 footprint of the investment portfolio, are actions that are frequently taken. This is likely to be driven even further by the new European law on pension funds, IORP2. The new directive that was published in January 2019 requires European pension funds to conduct periodic risk assessments that should, where relevant, include risks related to climate change, the use of resources and the environment, social risks, and risks related to the depreciation of assets due to regulatory change. Legal risks for corporates from climate-related topics. Running a business means taking and managing risks. Businesses in all industries run ESG risks, such as the risks of fraud or human rights violations in the supply chain, or violating environmental norms. Ideally, these risks should be mitigated by management in order to protect employers, local community, and shareholders from negative consequences. When these risks are not managed well enough, the company and its shareholders are exposed to financial risk in the form of fines and legal compensation payments. These type of financial risks are now starting to materialize in relation to corporate activities and behavior related to climate change, so-called climate litigation. A number of lawsuits have been filed against oil and gas companies as well as electric utilities over their contribution to climate change. In the United States, 2 states have filed lawsuits against a well-known oil major over its role in climate change. Faced with the possibility of devastating consequences brought by rising sea levels, 8 cities and counties in California, along with New York City and municipalities in Colorado and Washington State, have filed civil lawsuits against several oil and gas companies. And in Europe, a large German electric utility has been sued by a Peruvian mountain guide in its role of global climate change and the effects it has on the Peruvian community of Huaraz and their properties. A local German district court has taken on this lawsuit, which is currently in its 4th year running. This makes clear that fossil fuel companies now and in the future are exposed to risks of climate change-related lawsuits.
In this part, we will go into the topic of carbon footprint of companies and the impact it can have on investment portfolios. Carbon emission of companies, or also expressed as the carbon footprint of companies, are becoming increasingly in focus given the debates around global warming. This gained even more momentum after the Paris Agreement in 2015. Like ESG scores of portfolios, one can also look at the carbon footprint of investment portfolios. The carbon footprint of a portfolio can basically be calculated by looking at all the different holdings of a portfolio and calculate the weighted average to get insights into the overall carbon emissions of the portfolio. The greater the carbon footprint of portfolios, the bigger the potential negative impact and risks from this high exposure to carbon emissions. One could think about the risk of increasing involvement of regulators to drive down carbon emissions. This could be done through, for example, higher carbon taxes, regulatory fines, or cancellation of permits, all of which could negatively impact companies with higher carbon emissions. Furthermore, we could also see the financial markets shifting financial allocations towards carbon-light firms at the expense of carbon-intensive industries, which in turn could see demand for lower carbon-intensive firms increase and demand for higher carbon-intensive securities decrease, thereby potentially affecting the prices for these securities. All these factors increase the financial risk for carbon-intensive companies. Therefore, it is important to be aware of the carbon intensity of investment portfolios. Investors can reduce risk stemming from high carbon footprint by, for example, focusing on investing in industries and companies that have lower carbon emissions instead of the ones that emit above average emissions, or invest in companies that have a strong ambition to reduce their emissions. Furthermore, one could also focus on investing in companies that facilitate the transition to a lower carbon-intensive economy. And lastly, through engagement, so discussing with management teams of the corporates, investors can help push the companies towards a lower carbon-intensive future. So as discussed, there are several ways in which investors can actually steer their portfolios away from high carbon-intensive investments and thereby lowering the risk that the transition to a lower carbon economy can have on their portfolio. In the following part, we'll have a look at the concept of green bonds. One of the ways of integrating carbon emissions in the asset allocation, as well as supporting the energy transition, is investing in green bonds. Basically, a green bond is a bond for which the proceeds are specifically earmarked to be used for climate and environmental projects. These include projects that are aimed at energy efficiency, pollution prevention, sustainable agriculture, fishery and forestry, clean transportation, sustainable water management, just to name a few. One of the key questions when thinking about green bonds is often around the impact on the spread. In other words, is the spread of green bonds different compared to the spread of mainstream bonds? From a fundamental perspective, the difference between a green bond of a company and a traditional bond issued by that same company is very limited. Only the goal for which the proceeds of the bonds are being used will often be the key difference, with the green bond proceeds only being allowed to be used for the green projects we discussed earlier. The overall risks of the underlying issuer are of course very similar, and hence the credit spread should normally be very similar as well. In general, the spreads between green bonds and traditional bonds are therefore often fairly comparable, although we did see some tighter spreads in recent years in some instances. The explanation for this could simply be the strong interest in green bonds in combination with the still limited supply of green bonds. As a result, these issuers were able to offer a tighter spread for their green bonds when issuing these, as investors were willing to pay a small premium. In these cases, the question for investors would be if they should be willing to pay a small valuation premium for a green bond versus a comparable traditional bond. With the strong growth in supply of green bonds in the market, it is the expectation that spreads should converge further, limiting the spread difference between traditional bonds and green bonds. This, of course, makes a lot of sense as the risk profile regarding the issuer is almost always the same for both bonds. Furthermore, it is important to assess how green a green bond itself, or the corporate issuer of the bond, actually is. As there is no exact regulation around when an issuer can call their bond a green bond, it is important as an investor to make sure one feels comfortable enough around the intentions of the issuer. For example, can a traditional coal company also issue a green bond? And if so, are we confident enough that these proceeds will go to the green projects? Given the lack of regulation, every investor needs to decide this for themselves, and hence it is important to be aware of these dynamics. So to conclude, green bonds are a relatively new asset, providing financing that is really focused on climate and environmental projects. From a spread perspective, there's no strong reason why longer term the spreads should be different versus more traditional bonds, although in the near to medium term, supply and demand dynamics could still result in slightly tighter spreads for green bonds.